Hi everyone, this is Daniel Goott from Investec Wealth Strategies with a March 2016 Market and Economic Review. In this video, we'll talk about some of the economic headlines that influenced markets in the last month and give you some insight into what they could mean for you as an investor. After a rocky January for stocks, February didn't offer investors any relief. Volatility is still the name of the game. However, we did get some positive news. So let's talk about some of the month's major headlines. If you've been watching the news, you've probably heard a lot of talk about a possible recession ahead. So is a recession coming? Some economists are worried about a U.S. recession because of issues like low oil and commodity prices, news out of China, and fears that central banks are out of tools to fight economic trouble. These fears are not baseless. However, they don't necessarily spell recession. There are a lot of positives to consider as well. One indicator that argues against the coming U.S. recession is the labor market. The January jobs report showed that the economy gained 151,000 jobs. Even better, Friday's report for February's jobs showed a gain of 242,000. These gains maintained the headline unemployment rate at 4.9%, which is the lowest that it's been since February 2008. Another positive is that Americans are continuing to spend money, which is a good sign for the economy. In short, we don't know if or when a recession is coming, and neither does anyone else, regardless of what they say on TV. Recessions don't just happen for no reason, but we are taking concerns seriously and watching fundamentals carefully. Plummeting crude oil prices have had a lot to do with the negative sentiment in recent months. Crude oil prices are so low because the world is awash in it, and the supply glut, combined with slowing demand from China, is pushing down prices. Investors worry that persistently low prices mean that the global economic growth situation is growing worse. Low prices also cut into energy company profits, as well as those of companies with stakes in the energy industry. With 87% of the S&P 500 companies reporting already in, we see that overall earnings were down over 3.5% in the fourth quarter of 2015. However, if we remove the energy sector from analysis, earnings actually grew a healthy 2.5%. Firms that mostly depended on U.S. demand did even better. The overall economic picture wasn't as bad as expected last quarter. The second estimate of Q4 growth showed that the GDP grew 1%, not the 0.7% originally estimated. While economic growth decelerated in the last 3 months of the year, it didn't slow down as much as economists thought. Responding to concerns about economic growth, the Federal Reserve declined to raise interest rates again in its January meeting, keeping them low to help boost investor confidence. So while the Open Market Committee will meet again in March, most economists at this time don't think the Fed will hike rates again until the June at the earliest meeting. Bottom line, 2016 has been a rocky road for investors, and the volatility is likely to last for a while. While corrections and uncertainty aren't easy, let's remember that they are coming after years of solid equity growth. We're keeping a close eye on fundamentals and helping our clients make informed decisions based on the latest research. If you have concerns about your personal financial situation in the current market, please give us a call at 713-622-9111. We would be happy to speak with you. Once again, this is Daniel Goott with the Investec Wealth Strategies, signing off for the month of March 2016.